Welcome back. So 15 or 16 points higher, 12,954 is where we are at as far as the Nifty is concerned. Aditya Narain is joining in. He's head of research, institutional equities at Edelweiss Securities. Aditya, you're back on this show after a while, and I'm very sort of interested to hear how your views have evolved as the market has done what it has. I mean, just completely astounding, the rally that we've seen and that we continue to see. Incrementally, what from here? I mean, if you can run us through your thought process.
Yeah, fair enough. No, I think, as you said, it's been a phenomenal rally. You've seen it globally, but I think it's been very exaggerated as far as India is concerned in the recent past. So it has really been very strong. And I would say the fundamental backing to it has been the fact that operating data on the ground in India, whether it has been demand, whether it has been supply, has actually tended to consistently be a little better than what most folks had kind of expected, including ourselves. So I think there is the underlying underpinning of the fact that data has not been bad. It's been actually a little better than what most people expected. So I think that's one element. The other bit is clearly that there is a lot of global liquidity around that has sustained and has continued to find its way into India. So, you know, the fact is that you seldom had such strong markets where you had such a contrast between foreign money and domestic money. But the fact is that it has happened and it has swept the market up, right? In terms of looking forward, I'd say, you know, for a fair period of time, we were saying, let's look at Diwali as a benchmark for what demand is actually like, rather than the earlier months. And Diwali seems to have turned out reasonably well. I would still be a little cautious to the extent that it probably still had an element of pent-up demand that was there. So I'd probably push that weighting out a little further. But by and large, I would say the dynamics of the economy are back to a regular economy, firstly. Secondly, you've got corporate efficiencies that have come through in terms of cost cuts. And so you've seen, you know, EBITDAs look much better than revenues. Plus the reality is you've had liquidity that has sustained for a period of time. So that has given the extra push. So I would tend to believe the market will probably, it's full up in terms of valuations, it's full up in terms of performance, both absolute and relative. So I would suspect the market would actually hang around here for a bit, but look at signs in terms of what demand beyond what some of the pent-up demand was, which is where you need to be a little cautious.
And Aditya, morning, this is Rima here. And if it turns out that the demand has not actually normalized, it's more of, you know, it's not only pent-up demand, but of course demand is not back, you know, to what it earlier was. Considering valuations are full up, as you called it, what could be the risk to the market? What could be the extent of downside?
See, I'd say there are two elements of risk. One is, of course, there are some liquidity events, in which case the downsides can be reasonably sharp. The other is if you don't get the demand that you're expecting or the market is extrapolating, then you will tend to see market weakness and you will have periods of time where you're sitting 6 months on and you'll see the market a little lower from where it is today. So I think you have to look at it in these two contexts. If you get a combination of the two, whereas there is a problem with money flows and the data looks much weaker, then it could be much sharper. But my sense is that you'll probably end up seeing money support being there for a while. Demand support might be a little weaker, and so you might start seeing some level of weakness in the market.
Right. Aditya, we had Samiran Chakrabarti of Citi, your ex-colleague, earlier on the show, half an hour back on the show, and he kind of made the same point. He referred to, forced savings with a certain section of the spending classes, which basically has led to demand being propped up quite a bit. And he said he'd be watchful to see if that continues. I mean, that ties in with your point of whether the spending that we've seen all across sustains or not. Any way to, at this point, look at this? I mean, we can look at week-on-week data, but that is too short-term, too high frequency. Any other way to decipher whether this will last or not?
I think there are two elements to this. One is, I think, what Samiran mentioned, this twin track kind of performance, that one segment is doing well, the other isn't doing well, and at this point you can't figure it out. I think that's an important element. I think you need to look at it not just from a demand perspective, but also from a savings perspective, also from a jobs creation perspective, and also from who's gaining from this, which is I think what is tending to happen is that the bigger companies and the consolidators are getting the best of it, and those below the normalized line are struggling. And since the markets tend to look at the big boys or the largest players in the ecosystem, you can be theoretically misled in terms of the performance of one segment rather than in terms of the entire economy. So I think this is material, and I think one needs to keep an eye on it. Secondly, I think, again, the data is not out, but I think the early inference that we've got from a demand perspective, even for this Diwali season, has been that it's been the slightly premium classes, whether it is two-wheelers or four-wheelers, which have tended to see more of the demand than the lower end of the economy. And so I think this is a dichotomy which is going to be a challenge. I think it is a real risk. And while it does not flatten off the market dramatically, I think from an overall demand perspective, what it does is, this is what gives you what we had called earlier the shape of demand, right? There has been a lot of focus so far on the level of demand, how much has it sold relative to last year and stuff like that. I think the nuance will start coming through in terms of the shape of the demand, which is which segments are getting demand, which businesses are getting demand, and which sectors are getting demand. And I think that is something that you really need to see over the next couple of months, which will not necessarily have an overall market impact, but it could have a meaningful impact in terms of stocks and companies rather than the aggregate per se. But I think the shape of demand is probably a more important thing to look at now on than the pure level.
Absolutely, very interesting. Shape of demand rather than the level of demand. So Aditya, how would you play the shape of demand if demand is actually coming in, say from for premium products on account of the savings, the income savings that we've seen in the last 6 months? What would be the stocks, the sectors we could bet on?
So I think there are two ways of looking at it. At an overall aggregate perspective, I think our comfort lies much more where we are more comfortable with the structural level of demand, and a lot of that is quite honestly offshore. So whether it is IT, whether it is pharma, and to some extent whether it is telecom in the domestic market, we are more comfortable with the structural elements of demand rather than necessarily the cyclical elements of demand. So I think that's the big trade-off that we're really making as far as our portfolio is concerned. And that takes into account some of the risk we potentially see in terms of demand sustaining at the levels that are being perceived to have been generated in the recent past. So I think that's one level. I think the second bit is interesting in terms of if you were to look at higher savings and where they could go. Obviously, the market is one of them, and you're seeing some of it play through in terms of, whether it is stockbroking companies or just trading activity and investment activity from the retail space. Not that that finds a place in portfolios per se, but I think that is one place where savings play through directly. I think the second place to some extent is the real estate space. I think you've seen some of that in terms of demand, in terms of the fact that the entire ecosystem where pricing is also coming down, which is playing through. So I think that could be an area which could sustain a little bit longer. I would tend to believe, I think real estate, I think the dynamics have all come in together. You've got lower interest rates, you've got property prices that are a little lower, and you have segments of the economy which now have chunks of saving apart from this whole, potential shift to work from home, and so people want larger homes. I think that's the kind of cycle that you want. That's a cycle that's very sustainable, and that's not something you're necessarily seeing in the broader market, even though the fact that the broader market might be reacting a little bit like that.
Aditya, last question, and briefly, many are saying, well, we are at the cusp of an earnings upcycle. Do you believe that? If the answer is yes, what do you think will lead it?
I'd say two bits, right? I think clearly we're looking for the first time in many, many years, we're looking at earnings actually beginning to go up, that you will see earnings upgrades. And in this result season, you have seen upgrades. To be fair, the bulk of those upgrades have been for 21 numbers rather than for 22 numbers, but you have seen upgrades there. But I think that's one element of it. I think the other thing is you need to see where the earnings are coming from. I would tend to believe the bulk of these earnings have come from three elements. One is global momentum, which includes commodities and exports. The second is lower provisioning by banks, which, the early bit is always the sweetest, but that is something that could theoretically sustain given that the asset quality cycle has been so long, right? And the third bit is really in terms of cost cutting by corporates. So there is a big dichotomy between revenue increases and between EBITDA increases, right? And you've seen significant EBITDAs come through on the back of costs, right? Now, quite honestly, other than provisioning, which could be much more sustained, it could be more staggered than what people are anticipating at this point in time. The other two are more cyclical. So if you look at the international element, we think the global element, we are actually quite positive on that theme. But the reality is you've had a strong run there. You've had a lot of, you've had a lot of push there from fiscal authorities. But you're beginning to see some elements of lockdowns happen. So I think that can be a little bit of a risk. And the last one that I spoke about.
Aditya, Aditya, we'll have to leave it at that. Completely run out of time. So thank you very much for joining in. Get into a break. We'll be back with more on the markets.